Wow.
Exciting world in the mortgage business.
Wow,
Exciting
right?
couple weeks.
To see interest rates go, and it's being called the biggest increase in rates in the history of mortgages over a short period of time.
I'd say that. That's fair to say.
Yeah.
I've been in 15 years, the most I've ever seen in a 3 or 4 day window. And then if you look over the last 30 days, the biggest increase I've ever seen, even with all the volatility we had in 2007 and 2008, this is even more dramatic and faster than we've ever seen.
So when, I was talking with the other Ryan, who was just joining us, Ryan Smith, about what this does to buyers. Now, you work with a lot of buyers, obviously. Yep. How does this work? And I know you even have a couple stories on people who were going out to make an offer and things changed by the time they got it.
Mm-hmm. It makes a significant impact. And whether it's the discussions we've had on the show for the last 6 to 12 months, whether it be the discussions I have with my clients every single day, this should not be a shock. The escalation as fast as it came, that's slightly surprising, but this reality is not surprising to anybody. We've been saying for months that the next shoe to drop is interest rates. Interest rates will go up. It's the same discussion we had a year and a half ago on February 15th, where we said this is the bottom, that we're going to start seeing more activity in the real estate market, that we're going to see more of a seller's market come into play. That was the first shoe to drop that we said every time before that. Now is an amazing time to be a buyer because you have no competition. You have really good interest rates and no competition. Okay?
Oh, yeah, it was a year and a half ago we were saying that.
Yeah, and we talked about that as the first shoe to drop, is once the fundamentals of the market shift over, it's going to shift from a buyer's market to a seller's market, and that happened really fast. Okay, then we talked about the next shoe to drop is going to be interest rates. The people are so set on these 3.5, mid-3, high-3, low interest rates, and they plan their whole buying strategy around those interest rates that they have to go in that with a cautious feel, because on one day, as soon as the Fed changes their verbiage and changes their policies, rates will change. Okay, we didn't know exactly how that would look and what the context of that would be. We just knew this day was coming. So this shouldn't be a surprise, and buyers have to adjust and have that relationship with their lender again to come back to the table, reevaluate some things, and come back and choose if they want to come back on the market under the same strategy or a different strategy, or leave the market in general. But like Ryan said, you're going to face a new reality. You're going to stay, okay, I'm not going to buy for another 6 to 12 months. We're going to get some things figured out. Hey, rents are going up too. That's just the reality of what happens in this dynamic of a mortgage and real estate world.
So you've worked with some buyers, and I want to just discuss the pain of what this has meant to some people, though, who maybe were, who couldn't have been prepared. Nobody was prepared for it to jump this high this fast. Mm-hmm. And some people really did get caught in the middle.
They did. And I think the biggest challenge we face is the quickness of these rate adjustments. And I think a lot of it is emotional, which we can talk about that in a second. But really, if we talk about buyers that were putting offer, literally, this is a story of buyers that put, and this is a perspective for the listeners out there to understand the dramatic shift in interest rates, that we had a buyer putting an offer on a property last Wednesday. We talked about the numbers. They decided we're comfortable with these numbers. They made an offer, and sometimes the negotiation process for a house can take 2 to 5 days as they go back and forth. It was 4.25 with low costs. That was what they were going in at based on their financial situation. They were comfortable with that option. Now on Monday, Tuesday, they get the offer under contract. It's now at 5%. Okay. We spoke on Thursday. We spoke on Friday as they went up Thursday. They went up Friday, and they went up Monday, and they went up Tuesday. Mm-hmm. We discussed it, but that's a really tough reality when their payments go up by almost $200 in a 4-day window.
Yeah, and I think the other side of this is, that's incredible for a buyer, but even then, the people who are looking to refinance also kind of went through this. In fact, there's people who probably were thinking about it, and now it doesn't even make sense for.
And we can't, and it's a challenge we face in this market of being educators and being professionals and advisors to our clients, and the borderline of high pressure sales. Okay, there's an equal balance there, that if you have a good relationship with a good professional, you can't really look at it as high pressure sales. You have to look at it as someone giving you straightforward, honest, timely advice. Okay, I'm emailing clients last Wednesday. Here is a refinance option to save $400 a month. there is a volatile market. If you want to take advantage of this, now is the time to take advantage of this. If you wait, there's a risk of rates going up. Okay, obviously rates could come down, but there's a risk of them going up, and we're in a very volatile time. If it makes sense, get it done. They waited till Sunday to email me back and say, this sounds perfect, let's get it done. Interest rates are up 0.75% since that email on Wednesday. It's gone. It doesn't make sense to do it anymore. Mm-hmm. So that's how quickly things can move. And quite frankly, from the emotional side of it, I believe this is an overreaction to the Fed's comments about a rising interest rate environment over the next couple of years. Okay, the market shifted fast. I think we're going to start to see over the next couple of weeks a shift back on the lower position. Okay, because that just tends to be what happens. Way overreaction and then an easing of the markets. But that doesn't mean, in my opinion, we're going to get down in the 3s again, or maybe even the low 4s. We're going to settle out maybe in the 4.25% to 4.75% range, as opposed to, in some cases, up to 5.
Yeah, and the other piece of that, I think, is people still need to be prepared to make their decisions quickly. We talk about that a lot on this show. Like, do your homework up front, and when you're ready to make a move, you have to be able to make the move. We've talked about it on the real estate side when people are consistently out there and they know they're in a competitive market, but all of a sudden they don't have their financing in the ducks in a row, or they're not really sure about how much they can afford. In this case, not necessarily with the people who are buying the house, people who are refinancing. Sometimes when it's put in front of you, you have to take it. It's and people maybe don't realize it's like watching a stock market. You can't ask your lender, hey, well, our rate's going to go up or down. That's like calling your financial planner or stockbroker going, hey, if we buy Apple today, is it going to go up by next week so I can make some money? It's an asinine question to try to ask somebody. There's certainly indicators or whatnot, but there's no real crystal ball that you can look in and go, rates will be this tomorrow.
Well, and then that same analogy, if you come in and say, okay, you talk to your advisor on Wednesday, and they say, well, what's Apple trading at today? And they say 400. Perfect. Give me a couple days. I'm going to think about it. Then they come back, and now Apple's trading at 4.25. Like, no. I wanted to buy Apple at $400 a share, not $425 a share. The broker's like, well, that's the shift in the market, and that's the exact same analogy on interest rates.
Right.
It's a day-to-day, hour-by-hour movement that we have to focus. The best advice we can always give, and your show is great about bringing true professionals in who are advisors and advocates for their clients, is that we have to sit down, not only the way it was before, but the way it is right now, is to plan accordingly. Okay. Too many lenders out there will just say, oh, you want to be approved for $350? Okay, well, you're approved for $350. They give them a couple fee sheets and they go throughout their way. The most efficient way to do it is say, let's find out based on the market today how much you are approved for, and work our way down to a level you feel comfortable with, and then pad that approval with 1/4 to 1/2 point higher in interest rates, so that way you're comfortable with those numbers. So if they go up from the time you're approved to when you find a house, you're already used to it. Okay?
Right.
If they come down and they get better, that's even
You're happy.
Yeah, that's a great surprise, as opposed to the opposite, where people try to shop rate. They get shopped a really great interest rate, which is totally irrelevant until you're under contract for a house. They go through the process and they come back and realize that rate's not available just because of the market shifts. It's just not an efficient way to do it.
Yeah. Do you tend to, looking a little bit into the crystal ball and the overreaction, knowing where rates are, knowing what you know about buyers? I asked Ryan Smith the same question, but do you tend to think that this is going to scare more buyers into the market or out of the market?
Both.
It was an either or question, right?
Well, you have to look at the reality is that everybody's different for starters, but I'm already seeing that people are coming in and they're really escalating over the last 3 days their pursuit of a home, because they truly believe and they understand the fundamentals of what's happening in the market, that over the next 6 to 12 months, rates will be higher. Now, in the next 2 to 6 weeks, will they shift back down and have a correction? I believe they will. Okay. But over the long term, they know rates are going to go up. They know they want to buy a home, and they're escalating their offers, and they're scared back into the market to take action faster. Okay. Some buyers are flat out saying, hey, this changes everything. It's been a tough road to begin with. But this is the final straw. I'm taking 6 months off, maybe 12 months off, and reevaluating our objectives, whether it be the area we want to live in, the price range we're looking for, or even if we do want to buy. So I don't think it's a yes or no question. It is a little bit of both.
Yeah, for sure. I think you bring up a good point, though. It's the place you want to buy. And it's funny to always look back at the things you said before they happen, because, Makes you think you did something right. But, we talked about this too. People are starting to get displaced out of the core. And this bump in interest rates may truly be that bump that moves people out from the cities that they want to live in. Because now, if you wanted 400 or 500 and now you got to go to 400, well, guess what? You might still need the same size house. You might still like granite countertops, on and on and on, whatever it may be. But you no longer get to live in Redmond or Bellevue. Now you're out, another city further or another city further.
So absolutely. And with that same point of all the different shoes we've talked about dropping over the last couple of years, whether it be, hey, it's a buyer's market to a seller's market. We have record low interest rates and they're going up. What's that next shoe to drop now that this has finally happened? The fundamentals of the market say interest rates should not be in the 4.5% to 5% range. The fundamentals of the market say interest rates should be 5.5% to 6.5%, and that's a healthy economy, is having higher interest rates. And the Fed has made it very clear that within the next 12 to 24 months, that they're going to start not only easing off the buying of mortgage-backed securities, which is artificially keeping interest rates low, but they're going to start raising the prime interest rate, which really affects our overall economy and the cost of money, that will be happening in these. And the reason rates went up the way they've gone up is because the Fed made small hints that they're taking a really close look at their buying policy of treasuries. That, not that they're going to pull out, not that they're going to raise prime, just a comment that they're going to take a closer look at the overall fundamentals to see when is the right time to start doing that. Boom, within that time, 3/4 of a hitting rate go up.